Inflation is one big risk that you need to consider when it comes to your investments. You may have invested in stocks, in property, or even in government bonds. What is the effect of inflation on your returns? Now, inflation is extremely important because the returns that you are going to earn are in future. So, what is the effect of inflation on your future cash flows? This is what I'm going to look at in today's video. Before I dive into the video, I would like to remind you to subscribe to my channel by clicking the subscribe button. It's at the bottom, it's down here. For those that have already subscribed, a million thank yous to you. We've crossed over 1,000 subscribers, and that's a very positive thing towards the growth of this channel. So thank you so much to you all that have subscribed to my channel. Now, let's get started. Hello there, and welcome to the Ndalama Insights Business Show, where we look at finance management, both personal as well as business-related finance management. This is the channel where we turn your challenges into actionable insights. My name is Mukonkela, and I'm a finance and tax expert. Today, we are looking at the effect of inflation on your investment in the bond. It's one of the risks that you need to consider when it comes to investing in government bonds. Now, you might already know that inflation is the increase in the prices for goods and services. It's a general rise in the prices for goods and services. Now, what does this have to do with your investment in the bonds? When you look at inflation, it becomes very important. It's an important factor when you're looking at future cash flows. When you make an investment in a government bond today, you are making an investment today and expecting future cash flows. If we look at the example that we had considered in my previous video, which you can find over here, you discover that this person had invested 50,000 face value in a 5-year bond with a return or coupon rate of 11%. Okay? Now, today I want us to look at, are they going to get exactly, 73,000, which is what we had computed in the previous video? Is that what they are going to get when their bond matures? Or how does inflation affect that return? So, inflation affects the value of your kwachas, future value of your kwachas. Meaning that the 50,000 that you are investing today will not be worth exactly 50,000 5 years from now in terms of how much you are able to buy with that 50,000 kwacha. And so, I would like us to go back to the example that we had considered and look at the effect of inflation on the cash flows in this bond investment. Now, in order for us to understand the effect of inflation on the cash flows that are expected in your bond investment, your future cash flows, I'm going to go back to the example that we had considered in my previous video. If you recall, this person had 50,000 face value investment made in a 5-year bond with a coupon rate of 11%. Now, we had computed that the total cash flows that this person is going to get when the bond matures is the coupon incomes plus the face value amount. So they're going to get back the 50,000 kwacha face value amount plus the coupon incomes that they would have made every year. The coupon incomes, having taken tax into account as well as the handling fee, is an annual income of 4,620. Okay? Multiply this by 5 years, that gives us 23,100. So this is what they'll get. They'll get 23,100 plus the 50,000 kwacha, giving us a total expected income of 73,100 in 5 years' time. That is by March 2027. When this bond matures. Now the question is this 73,000 kwacha 100 carrying the same purchasing power okay, in 5 years' time as it is today? Is it worth the same? If we look at the cash flows or cash inflows over this 5-year period, which I've laid down in this table, you're going to see that year 0 is the day you make this investment in the bond, which is, remember, when you're investing in bonds, the biggest consideration is the face value amount. In this case, 50,000 kwacha. It's an outflow. That's why we're putting it in brackets, okay? So 50,000 kwacha, face value, and then there are 5 years. The inflows that you are going to be getting every year are the coupon incomes, which is 4,620 for the next 5 years. At the end, at the maturity date, you get your face value amount, 50,000 kwacha, plus the final coupon income, 4,620, giving you a total of 54,620. Okay. Now, assuming that there's no effect of inflation on these cash flows, we expect you to get back exactly 73,000 kwacha 100, and it's the exact purchasing power. Okay? Meaning that you get the same amount of goods or services as you'd have expected 5 years ago. Okay? So that's what it translates to. Now, life does not occur like that. The things don't happen like that in life. In real life, there is what we call inflation, which is the increase in the prices for goods and services. As we've already considered, inflation devalues the purchasing power or devalues your currency or your kwachas. Inflation reduces the purchasing power of your cash. So, the 73,100 will not have the same purchasing power in 5 years' time because of the effect of inflation. So let's now take a look at how inflation affects the value of your kwachas. In order for us to understand how inflation will affect the purchasing power of your money, we need to apply a discount rate. Okay, this is a finance term. A discount rate is simply a rate that considers the time value of money. And time value of money is really a concept that says that the amount of money you have today is not worth the same, 10 years from now, 2 years from now, or 5 years from now. This is because as the effect of inflation is applied on the value of your money, or because of the increase in the prices for goods and services, we expect that the value of the money that you have today will not be the same as, the value in 5 years' time. The value will have reduced. And so we have to apply a discount rate to the future expected income so that we understand what the present value of that future income is. So when we apply this discount rate, we are actually trying to understand what is 50,000 kwacha 5 years from today worth today. Okay? And in order for us to get this discount rate, there's a formula that we apply to get the present value of your future cash inflows. So in order for you to get the present value of your future cash flows, you need to apply this formula, which is 1/1 plus the rate, okay, and then to the power, the number of years. All right. So in our example, what we are doing is 1/1 plus, so let's just say 1/1 plus the rate, in this case the inflation rate. It could even be interest rate, by the way, but in our case we are looking at it we are using inflation rate. So plus 11% as an example, close the bracket, to the power, the number of years, in this case 1, and then you press enter. This gives you the discount rate, and then just drop this formula down to get these other values. Okay, then for you to get the present value, what is 4,620 worth in a year's time? Assuming that inflation is 11%, what is it worth a year from now? So you need to apply this discount rate. So you say the discount rate multiplied by the future expected cash flows. That will give you the present value, your purchasing power of this 4,620 a year from now will only be 4,162. Okay. Now, currently inflation stands at 9.9% as at July 2022 for Zambia, isn't it? And so for you to understand your present value of future cash flows, you need to apply this rate. So 9.9% will give you these present values of your coupon incomes. For year 1, we expect 4,200. For year 2, we expect 3,825. And then at the end of the 5 years, if the inflation rate continues being 10% or 9.9%, we expect you to get 48,745. Now, in terms of the actual money that is going to be given to you, you are going to get exactly 73,100 kwacha. But the purchasing power of this 73,100 is not the same. Because of inflation, the purchasing power is just 48,745. So with time, the value of your 73,000 kwacha is reduced or discounted because of inflation. So this is a big risk, isn't it? It's devaluing the value of your investment in this bond, because you will not be able to buy the same amount of goods or services in the 73,100 kwacha that you expect to get. That is the risk of inflation on your bond investment. And so the question really should be, what is the real rate of return on my investment in the bond? This is your real rate of return, because it takes into account the effect of inflation. Now, the Zambian government has a target to reduce inflation to a single digit. As stated in their budget of 2022, they wanted to come down to a single digit inflation in 2022, which they are just at the brink of. They've got 9.9%. We expect, as per their projections, inflation to continue coming down. They've targeted an inflation rate of a range of 6 to 8% by 2023, which is just next year. So let's assume that inflation comes down to 8%. What happens to the purchasing power of this 50,000 face value investment? It comes to 52,475. Supposing inflation rate comes to 6%, it comes to 56,824. So you need to watch how inflation affects your investment in the bond. Under the worst case scenario, supposing inflation rate goes all the way up to 22%, which happened, by the way, in 2021, inflation came to about 22.9% at some time. What happens to your investment in the bonds? Do you really get any return? It's merely 31,000. So you would have actually lost. Instead of making a return, you would have actually lost out cash by investing in this bond. Let's come back to a more realistic, future expectation based on the economic activity that's happening right now. We are going to be at a single digit inflation of probably 8%. This will give you your return of 52,475. That is the purchasing power of your investment. In real term, in terms of cash flow, you are going to get 73,100. Okay, in terms of the actual cash flow, but in terms of the buying power, it is only worth 52,475. That is the effect of inflation on your bond cash flows. Because there are future cash flows, you need to take into account the effect of inflation in this investment. Now, knowing what the effect of inflation is on your expected future cash flows is not to really scare you, but it is to help you compare against other investments. What is the real rate of return if I keep this money in a fixed deposit account? What is the real rate of return if I keep this money in a savings account? What am I going to make? Make these comparisons. In my future videos, I'm going to be making videos that actually compare the real rate of returns on your investment in a bond, in stocks, in a property so that we can make, financially intelligent decisions. We are just getting started, guys. And so continue following me, continue subscribing. So if you haven't subscribed, subscribe so that we can learn together in terms of how much are we really making by investing in a 5-year bond? How much are we really making by keeping money in a fixed deposit account? How much are we making by investing in a property that I put, on rent? Where should we be investing? Okay? Now, what do you do having known that, there's this effect in terms of the purchasing power of the future cash flows that you're going to make on your bond? What do you do about it? The first thing you need to do is keep an eye on the inflation rate. And if it's something you cannot bear, you can always offload your bond investment on the secondary market. That is why the secondary market is there for. In our case, it's the Lusaka Stock Exchange. You can always sell your investment in the bond, okay, on the secondary market. The other consideration is diversifying your investment. If you're just starting to invest, you might have just bought an investment in a 5-year bond, but also consider other investment vehicles. We've got property, we've got investing in stocks, that is buying, shares in other companies so that you're making, income through dividends as well as capital appreciation of your investment in that company. Again, these are videos that I'm going to continue making and diving into so that we understand. If we compare our investment in the stock against in the bond or against an investment in a fixed deposit, which one is giving us our value for money? Okay? So that is how you need to make use of this information. So don't just consider just investing in the bond, but also diversify your investment so that you have a balance in terms of the risk. Now, the other consideration could be investing in shorter term maturity bond. Okay, so bonds of shorter term durations or maturity dates. So you could consider investing in bonds of maybe 2-year period, so that, because the longer the bond, the more the years of this bond, the more you expose yourself to the risk of inflation. Remember, as time goes by, your money loses its value. That is why you are exposed to this inflation rate. So one way to manage this risk is to consider investing in shorter term durations so that you don't expose yourself to a very long period that results in a devaluation of your cash inflows. So those are some of the actionable steps that you can take to protect yourself from exposing yourself to this risk of inflation. Well, this is all I had to share in today's video. In my next video, I'm going to look at the risk of interest rates on your bond investment. So if you haven't subscribed already, subscribe by clicking the subscribe button. It's up here, so that when I produce this video, you get an instant reminder. Also, don't forget to smash the bell icon, because that is the only way you're going to be reminded that I've produced this video. If you have a comment, if you've got, a suggestion, if you've got a question, drop it in the comment section below so that, we can all learn from this. And if there's anything that I've said that you think doesn't resonate with you or is not actually correct, please let me know. We are all on a learning journey and I appreciate your feedback. Thank you so much for watching and see you next time.